My name is Pat O'Connor. I'm the broker owner of the Veritas Real Estate Group. We are located in Coral Springs. Today I want to talk about down payments, what they are, how much do you want to put down, what are the minimum requirements, and what kind of factors will affect your decision. To begin with, I'm only talking about standalone, single-family, owner-occupied properties. Investment properties and vacation homes will require a higher down payment than owner-occupied because it is riskier for the lender. Condominiums are a whole nother ballgame. FHA here in South Florida has very few approved condominium complexes, and recently Fannie Mae has put in guidelines for conventional loans. This was after the Surfside Tower collapse here in South Florida, and a lot of people, lost everything. And it was because a condominium didn't want to spend money on reserves and do special assessments. Allegedly, this is why repairs went undone, and finally it was too much for the towers, allegedly. Okay, so single-family primary residences, excluding condos. It depends on the credit score for FHA and conventional what the minimum down payment will be. VA loans have no down payment requirement. They can do 100% financing. So FHA, if you have good credit, 3.5% down payment. And this is 3.5% of the purchase price. For a conventional loan with good credit, first-time buyer, you may be able to put 3% down. Otherwise, 5% down if you're not a first-time home buyer. All right, so what are some of the things that will affect your choice to perhaps put down more than the minimum? There is something called mortgage insurance, which will be added to your monthly mortgage payment. So your monthly mortgage payment will be larger. This mortgage insurance reimburses lenders if they suffer losses when the property is sold, either because there was a foreclosure or short sale and it sold less than what the loan balance is. So that can happen, particularly during recessions. All right, conventional loans have what's known as private mortgage insurance, PMI. Again, its purpose is to reimburse lenders for losses. It is required on conventional loans if the borrower puts down less than 20%. The borrower can pay the entire thing at closing, or they can have it billed monthly and have it part of their monthly mortgage payment. It can range anywhere from 0.22% to 2.25% of the loan amount. And it's not up to you to choose the lender that provides private mortgage insurance. In most cases, it is not the primary lender who funds your loan. The primary lender will pick this secondary mortgage insurance lender to keep the escrow, to fund this part of it. So they're going to choose, so you don't have control over that. Unless you ask them, hey, what will your PMI be? And then you may be able to shop around on the basis of what the mortgage insurance is going to be. Higher loans may have higher expenses because it's a percentage of the mortgage loan amount, right? If you have higher credit scores, you may have a lower percentage for your PMI. For conventional loans, once you have 22% equity in your home, it will automatically be canceled. If you have 20% equity in the home and you have not missed your payments, you can request cancellation. So how do you increase equity? Larger down payment, right? So if you have 10% down payment, you have 10% equity in the home. And you need to get 12% more equity to, eliminate PMI. And the automatic elimination is based on the initial purchase price. All right. If you request a cancellation, they may do another appraisal or something they call a broker drive-by, get a real estate agent to drive by and get their opinion of value. And if prices have fallen, then you may not be able to get your canceled request, but you could still get it when it's 78%, because that's based on the initial purchase price. So ways to improve your equity, when you get your monthly payment, each month you can allocate a little bit more to go towards paying down the principal. Never pay down the interest, because the interest is based on the principal. So pay down the principal and you will build up the equity in your home quicker because there's less financing. As the loan balance gets smaller and smaller, that's counterbalanced with you owning a greater and greater share of the property. All righty? All right, for FHA loans, so that was conventional loans. For FHA loans, there is something called mortgage insurance premium, and this is MIP. And so this is mandatory for all FHA loans, regardless of how much money you put down. But if you put down at least 10%, you can cancel it after 11 years. That's great. Most people in the United States tend to move every 5 to 8 years. So you may already have sold your home before you could cancel the PMI. So mortgage insurance premium runs from 0.8% to 1.5% of the loan balance every year. It will be added to your monthly mortgage payment. So how do you decide how much down payment you want to put? So you got the minimum that you have to put. Now you got to figure out, do I want a higher mortgage payment each month? How much higher? Maybe I can get an idea from my mortgage broker what my PMI might be on this particular loan with my particular credit score. And then you'll see how much might be added to your monthly mortgage payment. Is it worth it for me to put down 20% so I don't have to keep paying this? Maybe I only plan to own the home for 5 years. 20% is, I would have assumed, much greater than what I would spend on the PMI in the 5 years. And you might have better things to do with the money than put it down as a down payment. For example, suppose a conventional is required 5% for you. Well, instead of putting down the whole 20% to avoid paying the PMI, with that additional 15%, you could buy an investment property, right? Be a landlord, or let a property management company handle everything for you. And they may charge somewhere between 7% to 10% a year. They'll take it out of the rents. They'll do everything for you. And so you're reinvesting that money, and hopefully the return is sufficient that it pays for the PMI that you're paying out. You also get tax advantages with investment properties that will further help you save money, because it may put you in a separate tax bracket, a lower tax bracket. So that's another thing to consider. Can you make more money with that extra 15% than you would, paying the PMI all the time? Are you short of cash? Maybe you can't come up with the 20%, and you really have no choice other than to pay the minimum. That's fine. Is there a family member that can give you the money for the down payment, all or part of it? Maybe you're going to come into an inheritance and they say, I'm going to give you part of this ahead of time so you can buy your house. For a down payment, there has to be a donor letter, if it's a gift, that says there is no repayment due on this gift. So again, if you're going to inherit some money from somebody and they have a lot of money, you may ask for an advance, and in their will, they could just say deduct such and such from, the estate proceeds. You may have a job where you expect to make significantly more money in the future. Maybe you're a medical resident and you're pretty darn sure once you get in private practice, you're going to be making more money. So maybe you're okay with putting down as little as you can now because you got your medical bills to pay, your school bills, and you're going to make more money in the future, so you're okay paying the PMI. So that's about it. This was short. So a little bit about the minimum requirements, a little bit about mortgage insurance, and a little bit about your choices. So I hope that this clears up any of the issues that you might have had about down payment. Okay, I will see you next Sunday. Bye.